Okay, everybody, good afternoon. Sorry about the delay. We had some technical difficulties there. Welcome to this week's webinar on Managed Futures by Walsh Asset Management. My name is Bill Revis, your host this week. I'm a managing member of Worldwide Capital Strategies, the highlighted CTA today. If you have any questions during the course of the webinar, please feel free to submit them. If we do not get to them during the webinar, we will be sure to contact you with the answer. Before I introduce Tom, our principal, and my father, I'm going to run through a standard disclaimer with you. Investment in futures contracts is speculative, involves a high degree of risk, and is suitable only for persons who can assume the risk of loss in excess of their margin deposits. You should carefully consider whether futures trading is appropriate for you in light of your investment experience, trading objectives, financial resources, and relevant circumstances. Past performance is not necessarily indicative of future results. The agenda today, we're going to look at crisis risks, managed futures, what they are and how they behave in crisis, basic overview of futures, how and why markets trend, systematic trading, and ingredients for good systems and investor behavior. Tom, our principal, was over a 30-year veteran of the Chicago Mercantile Exchange, only 625 full members. In 1984, Tom began managing money for investors. He developed rule-based trading programs. With the advancement of computers, these became known as systems trading. Today, about 84% of all CTAs describe themselves as systems traders. Tom was one of the early adapters of systems trading, which he made available to both individual and institutional investors. In 2004, Tom founded Worldwide Futures Systems, a full-service commodity futures brokerage specializing in systems trading. This combination made for a unique offering for those customers seeking an investment in commodity futures. In 2013, Tom founded Worldwide Capital Strategies, a CTA which utilizes top systems which have been traded by Tom and myself for our client base for many years. Now I'm going to introduce Tom to you and give control over to you. Let's see. And you should have control now.
All right, let's hope so. All right, thank you for stopping in. I am Tom Revis, and I think a lot of you are familiar with futures, but you may not be that familiar with managed futures, and you're almost surely not familiar with our product, so I'll try to give you a rundown on that. America today is in an investment dilemma. Most large and small investors need to remain invested in equity. Because of the institutional business, because of their large size, all of us are in need of income, and to keep capital gains, you need to stay invested. But we have a unique situation in the United States that's going to become huge, I feel. Baby boomers are retiring at the rate of 10,000 a day. Normally, these retirees would be going heavily into the bond market, a safer investment. But what you're finding is because of very low engineered returns for bonds, the baby boomers are being forced into riskier investments, and that's the stock market. Most investment strategies are susceptible to suffering devastating losses during a equity market crisis. Almost any investor needs true diversification, and I can tell you they don't have it. Adding more stocks to your portfolio and saying you're diversified, as most people found out in 2008, isn't going to do it. When the market goes into crisis mode, 100% of stocks often go down. So diversification, unless there's low correlation, won't work for you. But adding an investment in portfolios which during turbulent market periods is an alternative asset, and that's what you should be looking for. Managed futures helps create this needed true diversification. Equity crisis period over the last 20 years. You should be able to see here that they're not that infrequent. You have the Russian debt crisis, tech crisis, the accounting scandals, credit crisis, the Lehman Brothers failure, and the flash crash. So they are becoming more prevalent. Okay, let me go back hopefully. All right, what we want to look at here briefly is what happens in an equity crisis. Well, first we know the market goes down, but what we have is an industry with a huge long bias, and institutional investors are in a position where they have risk limitations, which they have to address. So when the market goes down, it forces investors into action. And large groups of investors flee some of the asset classes and herd into others, desperately seeking liquidity. This causes persistent trends across a wide range of asset classes. The select few market players who are able to adapt can exploit these trends and deliver crisis alpha. You know, one of the things that a lot of people say, well, it doesn't happen very often, but the fact is that it does happen often. And this is a list of just those declines of over 50%. So we had in 1911 to 1920, we had a stock market crash of 51%. And then, of course, we had 1929, 90% nearly crash between 29 and 32. Then the bond market suffered a 67% failure from 1941 to 81. Stocks in 73 to 74 dropped 50%. And the UK, they dropped 74% over that time period. 62% drop in gold. Oil has dropped 71% in 6 years, 1980 to 86. Japan, in the last 20 years, between 1990 and 2009, dropped 82%. And then, of course, the last two crashes, 49% in 2001 and 78% in 2001 in the NASDAQ. And then the last one in 2008, where the market dropped 57%. So there's a long history of failures of the stock market for over a 50% drop. So as Yogi Berra would say, it's deja vu all over again. Statisticians would say that what's occurring shouldn't be happening, but it is. They would say that there's a theoretical distribution of the equity curve would indicate that these would be very seldom and far between events. And if you look in the upper corner here, you see that the bell-shaped equity curve actually flattens out prior to getting to 17%. And so the event of 21%, 25%, or 29% statistically are improbable. But that's not what's happening. What we're instead seeing is what we would call a fat tail equity curve, and that is showing that 13%, well, theoretically shouldn't happen. They're happening frequently, 17% frequently, 21% frequently. It isn't until you get after 29% that the equity curve actually comes down to probability being low for drops of that size. So what does this mean to investors? it means frequency is increased. In systematic crisis headlines, you see almost every day. Analyzing, understanding, tracking fundamentals and technicals of a crisis is not an actionable plan to protect your portfolio. Once you're in a crisis, it's probably too late to create a plan and to protect your portfolio. The average investor has no plan to deal with critical financial situations. Yogi Berra again, if you don't know where you're going, you might wind up someplace else. If we look at 1981, 87, 2000, 2001, 2008, it happened, and the average investor still has no plan to handle crisis risk. Most of the people get their advice from their financial advisors. Financial advisors who are not licensed to sell commodity futures are telling their clients what to do. Traditional portfolio risk mitigations are to hide in cash, but you're missing out on dividend income. More equity into more equities, which is non-diversification. Market timing, which I can tell you for a fact doesn't work, because I have had a branch offices and had customers and brokers for almost 50 years, and I can think of only 4 or 5 guys who were actually able to market time over a large period of time. So I find it very interesting that the brokerage houses continue to push managing your own money, because people actually do a very poor job of it. As in fact, Fidelity recently did a study and found that the most successful group of accounts that they had were accounts that people forgot they had. In other words, they never traded them, and those were the most successful. So actively managed accounts have very little chance of success. But they're profitable for the brokerage houses, so you keep seeing people recommend them. Other approaches: hedging, options, inverse funds, sell stops. Brokers offer what they are licensed to sell and that they know, but and buying more hedge funds. For most, these strategies are not employed. They become cumbersome, expensive, and they do not fully solve the problem, and they might cause more portfolio management issues and unintended risks. This is where managed futures comes in. Managed futures is an investment asset class and is part of the alternative investment category. You use global futures and other derivatives for investment. They are managed by the commodity trading advisors, and they're regulated by the National Futures Association and the CFTC. What managed futures are not. Managed futures are not more risky than the stock market. Regardless of what anybody has told you, that is not true. And stocks, the second thing is stocks have to go down for managed futures to go up. There is zero correlation between stocks and managed futures. Therefore, stocks can go up when managed futures goes up, and they can go down when managed futures just goes down. There's zero correlation. But we do know that when stocks go into a major down, the managed futures almost 100% of the time will go up. I wanted to show you the chart of stocks against the managed futures index and see which you think would be less risky. The stocks are in orange. Managed futures index, as you see there, is in aqua. So you see a very volatile stock market up and down, most of the time underperforming the managed futures index. Only 3 times, actually, since 1980 has the stock market outperformed the managed futures index. That was in 2001, right before the crash. Again, stocks almost outperformed the managed futures index in 2007, right before the crash. And today, so the question is, where do you invest your money now? And the triggers that could cause a major stock collapse in the world today are numerous. I've listed just a few of them. Middle East terror groups, the entire Middle East is a tinderbox. The instability in Europe and Greece, Russia at war with Ukraine, the potential of war between Iran and Israel. China is something we could talk about for an hour here, but basically the Chinese industry, which is the world's largest economy, is now in the period of slowing down, and the stock market has been actually dropped 35% in the last few weeks, and they're doing incredible things to try to stop it from going down, like can't sell out your positions. They've delisted many, 64% of the stocks, and major holders of equity can't sell their stocks. Also, the crude market, which is very unstable, it's taken some big run-ups and big runs down. So there's a lot of triggers that could cause major problems. Managed futures is thought of as a small industry. It is not. It's large and getting larger. If you look at the graph here, you see that past 2007, it's increased substantially, and people are becoming more used to it. Most of this advance, however, is in hedge funds, who found that even though they thought they had good positions, had to raise liquidity and sell good positions during the last crash, and so they have bought heavily into managed futures in the last few years. Managed futures has a long history of doing well, and here are some of the returns over the last 20 years. But the real interesting thing is that they have a very long history of doing very well in times of equity crisis. So if you look at 1981, you see a 24% increase in managed futures and a 9% fall off in the stock market. 1990, 21% drop against a 21% gain against a 6% loss. 8% gain in 2000 against a 10% loss. 2001, a 1% increase against a 13%. And then, of course, in 2002, 12% gain against a 23% loss. And in 2008, a 14% gain against a 38% loss, a 52% difference. So this chart, again, kind of helps you visualize what the managed futures can mean to your portfolio. When the stock market really takes some big drops down, managed futures tends to go up and smooth out that equity curve if you're involved. For those that say you're a broker who may say that managed futures is too risky, again, this helps show that that's just simply not true. Managed futures largest drawdown is over here in the left. Then you have the FTSE, the Dow, the S&P, the World Index, the DAX, German index, the Nikkei, Japanese, and the NASDAQ. This chart on the bottom shows not only the depth of the drawdowns in the S&Ps compared to the CTA index, but also the time that it took to recover from these drawdowns. So the market is uncorrelated to the stock market, but how do they actually make money? In order for an investment strategy to be profitable, there must be an underlying fundamental reason for the existence of a profit or opportunity which the strategy can exploit. Since managed future strategies rely on only the most efficient type of trading vehicles, they must profit from persistent trends in the market, which, given that markets are efficient, should not, under ordinary circumstances, exist. But both uptrends and downtrends exist all the time. Equity market crisis is the market scenario where predictable behavior and, as a consequence, persistent trends will be most likely. So this gives you a chart of what funds look like, or hedge funds look like in crisis situation, and the right side is what CTAs look like historically in crisis situations. I spoke at a hedge fund conference in Miami a couple of years ago, and my question was, what were the hedge funds hedged against? Because their programs have just historically not protected the investor in crisis situation. As you can see, all these are hedge funds strategies to the left, and it is to the right here where we go into agricultural traders, CTAs, currency traders, CTAs, discretionary traders, CTAs, that you start to see a profitable history during crisis. Here's one of the things that I like to take a look at. It's called the efficient frontier. Once you've decided that, yeah, I'd like to be in managed futures to make money and protect myself in a volatile or erratic market situation, how much is the perfect amount? So one of the ways we can look at it is this efficient frontier graph. This is, if you look at 50% bonds, 50% stocks, you see a volatility index, which would indicate how much risk you have. As you move, so that shows basically you had about 7% return on just historically on 50% bonds and 50% stocks. As you add managed futures to that mix, you see that two things happen. One, you're reducing your risk or volatility from over 8.5% to down to 6.5%, and you're increasing your return to up over 8%, close to 8.5%. So that's 20, and so that efficient frontier comes in historically at 20% managed futures, 40% stocks, and 40% bonds. So what type of managed futures? There's many should you participate in. Fundamental, algorithmic, a combination, high frequency, day trading, medium to long term. I think it's best to look at, focus on strategies that could potentially do well in normal times and potentially do very well in times of crisis. So we're looking for a robust system that works in most markets, but not all. One that has strategies that typically add crisis alpha, that cut losses short and let profits run. Everybody's heard of that, right? That's investing 101. We like an auto-traded program that takes emotions out of it. We like a diversified portfolio, short-term trading, medium-term trading, and medium to long-term multiple commodities. And so we look to catch outside, we diversify out enough to catch outside moves in a variety of futures. So we want to be the consummate managed futures program, as Yogi was the consummate baseball player. And 7,555 times at bat, he had 2,150 hits and 358 home runs. The consummate baseball player. So we're looking for a diversified strategy to make us a consummate program, one that trades deep markets. So we have indexes, interest rates, currencies, energies, metals, grains, meats, softs. The list of commodities that we trade are all listed at the bottom there. And we're systematic traders and systematic traders. We don't try to forecast what the markets are going to do, but rather we are reactive. Why would we do that? Why not forecast the market? Because the best forecasters in the world, if you look at them at the end of the year, they did a terrible job. If you have any doubts about that, just look at what people forecasted and look at the end of the year and see what came true. Very few people very few of your pundits are actually very accurate. So our program is called the Profit Quest Strategies. We have a nominal investment level of $200,000, but we can easily trade it at the $100,000 notional level. Over the last 12 months, we've shown a 42% return. Our average rate of return since we started is almost 9.5%, and a total return is 51%. This is compiled by independent third-party auditors. So what does Profit Quest look like when you're trading it? A lot of people try to compare a managed futures program to the stock market, and that's not going to be easy to do. It's non-correlated, so you really wouldn't expect it to perform like the stock market, but most people are disappointed. The stock market tends to make a little bit of money every day, so it's easy to stay into, a little bit every month, a little bit every year, until it has a catastrophic drop. We see it has the equity curve like a Thanksgiving turkey. But commodities trade differently. They tend to make money, a little bit of money, or lose a little bit of money over a fairly long period of time, and then have brief periods of time where they make a lot of money. So I want to give you an example of a few commodities that we've traded over the last year, and you can see how they act. Crude oil would be a good example of what we might see. Our program only makes money about 43% of the time. So you're talking about a program that's basically losing money 57% of the time. So if we look here, last part of 14, our 2014 through the first part of this year, you saw that crude oil lost money, lost 1%, lost 1%, lost 1%, and then we caught a $38,200 profit, followed by another almost $3,000 profit, and then a $4,300 profit. If you weren't auto traded, when you got to this point right here, you might have been tempted not to make the trade, right? I know I would. But being auto traded and a systematic approach forces you to do the right thing every time. So lean hogs is another example of which you might see. It had a couple of losses here of around 1%, a little bit less second trade. And then we have about a 1% profit, another about a 1% profit. Then we have nearly $10,000 profit, and a couple of 1% losses, then a $3,000 profit, a small loss here, and then we finish out 2015 with a $6,000 profit, a $600 profit, a $2,000 profit, and then a $2,000 loss. So you're getting that 40 to 60% profit to loss, but it really it relates to good returns if you get when you get these big trades. Australian dollar is another example of it. Here it's more even, which you might see in over a period where you're making a little and losing a little. You have a 1% profit, 1% loss, 1% loss, 3% profit, 1%, 1%, 1%, and 1% losses. So you made a little money there, but not a lot over that period of time. And finally, we'll look at the euro currency. Again, you had here 5 trades, loss, 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 all of about 1%. Then we have $8,000 profit, followed by a $13,000 profit, followed by a $5,000 profit, followed by a $2,500 profit. So this is an example of cut your losses short, let your profits run, and if you're using these systematic programs, it's all you just need to be patient and follow the program. This gives you an indication of how we've done compared to the major indexes. Now you'll say, well, you look a little volatile to me compared to the index. Well, index are trading hundreds, in some cases thousands of programs. We're a single program, so we're going to be more volatile, but we're also considerably more profitable. So I'm suggesting to you that you create a plan to truly diversify your stock portfolio. You don't need to get out of it. In many cases, it's not right to get out of your stock portfolio. But it's very hard to stay in a stock portfolio with no protection. And with the stock portfolios has been what we often think of as where you can't compound. They're compound killers. So if you're in the commodity market in managed futures, you should expect to see your equities first smooth out. Secondly, you want to add approximately 20% your managed futures to your portfolio to help build wealth and address risk prices. That's your frontier right there. And as Yogi would say, don't make the wrong mistake. So thank you for your attention, and I'm sure I may have created more questions than answered them, but be happy to answer any questions you have. So I'll turn it back over to Bill.
Yeah, again, thank you for coming. Again, if you had submitted questions to the webinar portal, there is that option, and we will get back to you with answers to those. And here's our contact information. You can reach us directly at 800-982-5321 or info@wwfsystems.com. That concludes the webinar today, and we will pay attention to your emails because there will be other webinars on managed futures in the future.